All right, good afternoon, and welcome back to the Money Advantage podcast. I'm excited to be joined by two gentlemen that I greatly respect and admire, one that I love dearly for almost 20 years, being married to Lucas. I'm really excited to have him join the show today. And Bruce, I am so glad to have you in this conversation. Today, we're talking about Lucas and I's personal family bank, the Marshall Family Bank, and the updates for that. And I love being able to have this dialogue every year about the updates on our policy, really to be able to show what's happening inside of a life insurance system of policies, a family banking system, why we're using it, and really to drill into the performance as well. What's happening kind of under the hood as we're continuing to pay premium, as we're using this policy, these policies. And I love having this conversation with you, Bruce, because there's so much that you bring to light as you help clients always every year kind of walk through what's going on in their policies. It's really exciting to be able to share this with our audience through the podcast. So, first of all, thank you guys for being here. I'll kick us off after we kind of just say hi. So,
Great to
thanks
be
for,
here.
and Bruce, good to
Yeah,
see you
it's
again for
it's.
this.
I actually think it's nice to use using yours and Lucas's because my six contracts are all over the place. From everything that I do, how some of them are, really old, and some of them are relatively new. 6 years new, and some are 10 years. And I have some long-term loans from some investments out, and it's all over the place. Yours and Lucas's are relatively simple, like our normal clients would have. And so I think it's really nice that you two are willing to pull back the curtain and show everybody.
I'm really excited to talk about family banking in general and why we do this. And just, I would like to kind of give a kind of a 30,000 foot overview, kind of paint with broad strokes here, especially for somebody who is coming in and saying, first of all, I don't know what family banking is. I'm really not that familiar with infinite banking. Why are you guys using whole life insurance? So I just want to give context to this conversation before we kind of get into maybe an engineer's perspective or the mechanic if you're looking at the car. We're going to talk about the car and the body of the car first. So I want to just share, first of all, I'm really excited that we have been using infinite banking now for 13 years. And that is really, we call it 13 years, right? We just had the 13-year anniversary. We started in December of 2012. So a little over 13 years ago. And it's exciting to me because it's something that now has a traction. It's not just something that is futuristic. It's not an ideal, something that we haven't yet realized. It's something we're doing. We're in the process of doing. So, first of all, that is something that I want to share with you. And so, this 13-year family banking system, I'm just going to give a super quick flyby of why we got started in the first place. So, originally, we were storing capital, a lot of money in gold and silver. We realized we had a need for liquidity. We were starting a business, and gold and silver were actually down in was it spot value, spot price at the point that we wanted to capital or get money out of that asset. We realized that's not a good store of accessible capital. It's great for a long-term store, but if you're looking for something that is liquid and usable right now, it wasn't the ideal solution for that. So that was one of the reasons that we first started looking at life insurance. We heard about the infinite banking concept, and for us, it was this idea of we need liquidity. Liquidity is a really important word, but that just means that we needed access to our cash, and we didn't just want to put it in the bank because of course, it's not going to do much for you. It's not growing that much. We needed a place that was going to be safe, that was liquid, and we could use it. And so we started a life insurance policy with $10,000 a year back in that December 2012. And then over time, we've added policies. We've exchanged one policy for another policy. And so we had capital move over from that one. And now we're 13 years in. And so you're going to see a little bit more of the actual dollar amounts that we're putting in. But really, that was the main reason that we started the infinite banking process. And then later on, as we were in the field as well, helping other people to understand this tool that really gives you a lot of control and certainty in your financial life, we realized that there's another really important ingredient, and that was the death benefit. So we had gone ahead and used something called human life value, simply means the total amount of economic or dollar value that an insurance company would put on your life. It's also the amount that, what do they say? And if you were killed, what's that term?
Wrongful death.
Yeah, wrongful death, or if you died, what a judge would award to your family in terms of an amount that you're.
Your income potential for your income potential. Yep.
Yes. So based on what you're making, how old you are, the number of years for the rest of your income earning years. And so there's an actual dollar amount that you can find that is the economic value of your life. And certainly we believe life is infinitely precious and worthless, or worth infinitely valuable, not worthless, though, the opposite word I'm looking for, but to God and to each other. But the economic value was really important. So we wanted to make sure we had as much death benefit as possible. So we weren't just saying, how do we have whole life insurance policies, but how do we also have term life that is going to make sure we have as much death benefit as we can get? And that became extremely important then when I had a near death experience about 6.5 years ago. That was really the catalyst for us thinking completely differently about money and estate planning so that we could really not just provide money to our kids and grandkids, but to give them the values that they need for using it well and stewarding that wealth into the coming generations. And so that's turned into a book and a movement and consulting and coaching and a summit that we provide on legacy wealth planning. So that's kind of the big picture. Is there anything that you would like to kind of go back and fill in any details for things that I missed that was really high level? I know.
Well, just to point out, for the purposes of the information we're going to show today, well, we started 13 years ago because we exchanged a policy. Really, we're in with the new policies, we're in year 5. We paid the fifth year's premium, so they're not going to see 13 years of information. So I think I just want to be clear to the listeners because we exchanged a policy. It's called a 1035.
1035 exchange. Yeah.
We moved the cash value from one policy, started and then started two policies, and so everything is kind of like a reset button a little bit. So just want to make that clear.
Is there anything else you want to say about why we are using this, or what we were hoping to accomplish from the beginning, like why we got started with infinite banking?
Well, the multi-generational aspect, being able to have a cash flow system somewhere
Yeah.
to have capital that we had control over and could use for large purchases, as well as knowing that there's a guaranteed death benefit that will increase with each generation. So if our children continue this, then we'll have this always growing pool of capital available to the family. So that is, it wasn't just for the future, it was for both the future and now.
I'll actually point out as well that Lucas is such a researcher and he wants to understand something really well. And he's really leading our family in terms of making good financial choices, setting us up for the future. And so as we were coming into first even understanding the idea that life insurance could even be a possibility of a tool to use for having liquid capital, really Lucas you were looking for a lot of safety, you were looking for guarantees, you were looking for something that we would know what it would look like in the future, that we could predict certain dollar amounts, because you really just didn't want, we weren't looking for speculative, risk-based capital. We were really wanting something that we could count on. And so that led us into a lot of research, which is how we ended up finding life insurance to begin with, which is probably counterintuitive if you're not familiar with this type of a conversation. Why are you using life insurance as a financial tool? It's really robust in terms of having this ability to not just have a death benefit, which is what most people think, but it also has this growing like equity inside of the policy. It's not called equity, it's called cash value, but it's this growing amount of the capital that you've placed into the policy that you can access and use. And one of the things that's, I think, really important for why we're having this conversation at all is that if you are in a position of maybe like we were saying, hey, let's start exploring infinite banking. Let's get get a policy in place. We have capital we want to preserve. We want to put it into a system that we can access and use. We want to be able to borrow against our capital, which is a key feature of what you can do inside of a life insurance policy. You might be looking at what's called illustrations. And these are the projections of what's going to happen before you start. And that is giving a trajectory of what you could expect, but it's not a guarantee of performance. It's really showing what the expectation is. And so there's a lot of value then in looking at not just futuristically what is expected based on an illustration, but now standing in the middle of the stream, if you will. We haven't just, we're not standing on the banks anymore. We're in the middle of the stream. Now we're saying what has happened? What has the performance actually been compared to what we thought when we were getting into it? And I'm just going to give a spoiler alert. It's good. And we're still committed to this process because it's really good. And it's exciting to me every year when we get to pay our premium because we planned for it all through the year. We get ready, we pay our premiums, we watch our cash value go up, not just at that point, but all throughout the year as well. And so we're getting to a really exciting place in our policies where you might hear of this term called break even. We're getting, I think you're going to show that, but break even doesn't happen day one, meaning you've put more capital in than what you can access right away. And we're getting to a point that we're starting to really see some tremendous traction and payoff in these policies. I don't know if you'd say we're at break even yet or not. Yes? No?
No,
Almost.
no, we're not there. No,
Almost.
no. It's like 4 more years, I think.
Okay.
I don't know.
Well, it's a lot closer than it was when we
Yeah,
started. So,
As far as your lifetime, that's really close when you think about it.
yeah. No, I just when you say close, like define close.
Yeah,
Yeah,
that's what I mean. So it's really an interesting thing when you're talking about, break even. To me, sometimes break even isn't even important, because it's what you're trying to accomplish. So, we could talk about the relative closeness to it. Is it close? Is it not close? But we could also say it's not even that important, because what you're trying to do is just try to mimic the banking function. And we were talking about this with a client the other day. It's like they were saying, well, we want to get to that faster. And I'm somewhat of a researcher too, not like Lucas, but I'm a researcher. And so one of my favorite guys to listen to is Thomas Sowell, the great economist and philosopher. And he once said that there are no solutions in life. There's only compromises. And so I think this is a great example. Everybody's looking for solutions, solutions, solutions. Well, nobody has the exact solution. We just have compromise. If you get this, what are you giving up for that? And so that's what I think the audience should be thinking about all the time. It's like, well, what are you trying to do? And our friend James Nethery says the number one thing that everybody has to deal with is accessing capital. Capital, capital, capital. We use it on our daily lives. We're either spending it, we're either accumulating it, or we're accumulating a bill that we will eventually need to use capital to pay it, like your
right.
light bill that's on right now. So there's a meter outside your house running up now, and that's your capital just flowing away from you on and on and on. So it's really about a money management system. And we can talk about design and all this other stuff. And we can talk about break even. We can talk about early cash value. But the bottom line is you can never have too much capital. And so if you just focus on paying premium, which is capital, and then it accumulates, then it solves everything. In the Coaching Academy for the Nelson Nash Institute, they say the answer to everything is premium, because premium is capital. So that's the answer to everything. You have a question? What's the answer? Premium. So just think about that in your daily life. If you have a question, what is the answer? Premium.
Well, and especially if it's a financial problem you need to solve. Because, I mean, I think, Bruce, you really hit on something that wasn't top of mind to us when we first started the policy, and that was the idea of becoming your own banker. I think that's something that we're more so growing into this idea of what does it mean to control capital? What does it mean to be in the position of accumulating and growing capital that we then have choices with, right? Now we have this cash value. Now we could deploy it. We could keep it growing. We could deploy it in any number of situations. We could buy a car with it. We could use it for paying our mortgage. We could use it to pay taxes. We could use it to do anything with. But we're then having to make choices to say, okay, how are we going to use this? But primarily because the first step, which the answer to the problem, whatever question it is, the question that we were trying to solve was how do we have money that we can get to when we want to get to money? And I mean, at the core, that really is what it was. We can call it an emergency opportunity fund, which is what we call it, but we wanted money that we could access when we wanted to get money, which meant we have money for buying investment properties. We have money for investing in our business. We have money for buying a house. We have money for whatever we need. And we have a storage tank of stuff of money that if some need arises that we don't have accommodated in our normal everyday flow of money, that we can rely on, that we can lean back on that. And so that's exactly what capital is. It's having this accessible cash. And the answer to that was funding life insurance policies, putting premium dollars into life insurance contracts so that we could build up this capital, which allows us to then be in that position of control and be our own banker. So let's go ahead and dig in here. So, um, is there anything that you want to say about how we designed the system to begin with, or do you want to just kind of jump into the update and
Not
start
really.
showing
I mean,
numbers?
other than it wasn't so much like you were saying earlier, being risk averse. It wasn't about risk averse as much as, I mean, who wants to put their savings at risk? So
Yeah, that's
um,
true. It was
it's
savings.
not an, yeah, so it's not an investment, but it's a foundation from which we can now go out and invest with the capital that we've built up. But I wouldn't want to put our savings at risk, and that's what we kind of found with precious metals was it could go up, it could go down, but at the moment you need it, it might not be where you need it to be when you want to liquidate it. Wait, is liquid, we could liquidate it, yes, but would the value at the moment we needed it be what we even paid for it at that time? And what we found out is no, it's not always going to be. You can't guarantee that. Whereas with this, we knew, whatever our cash value is, it's not going to go down. So that was the reason for
That's a really
changing the vehicle. The safety component of this is because it's not an investment and it's for the purpose of having access to capital.
And that's a really good clarification as well. I think it's less an overall philosophy where I made it sound, I wasn't trying to, but I was making it sound like risk versus safety. And that's really not that question. The question is, what is the purpose of this money? And the purpose of that money was savings, which is a safe storage of capital that we can access and use. And so that's really where the starting point of this family banking system came to be. One other thing I do want to say before we get started in this, and this is something I share in the Seven Generations Legacy Masterclasses, is that we're revealing we're pulling back the curtain. I want you to hear that this is maybe a microcosm of what can be for you. This is not to show you that we're doing something that is better than everyone else. I do want to just say the numbers might be a lot or a little to you, wherever you're coming from in your financial life. The principles are really what hold true and hold steady. And so I want to encourage you, if you are just getting started or if these numbers look really big to you, that getting started, Bruce, you always say small steps, but quality steps. A step in the right direction, controlling capital is always really valuable and advantageous to you, even if maybe you feel that you can't make as large of a commitment to something as we are doing right now. And you might also be on the opposite end. You might be saying, those numbers are really small. They don't even make sense in my world. I'm dealing with much bigger numbers on a regular basis. And still, the principle applies. So I just want you to see what we're doing and why and how it's working because you can apply the principle and the learning from this to your life.
Ultimately, too, a lot of the numbers we're going to share probably don't really matter. But
True.
some people, or a lot of people, I think, want to at least understand it. And so that's the primary purpose for this, is just to be transparent and for people to see like what we're doing, but also to just for being able to understand how things work. I know there's a lot of people, at least I wanted to understand it when I was doing it. Some people just want to have a deeper understanding. So hopefully this will provide answers to some of the questions people may have. But really, the principle and the concept of what we're doing is what matters more than the getting deep into the weeds. Although we'll do a bit of that in this episode because that's what we're doing.
All right. So, do you want to share or do you
Yeah,
want me to share?
pull up the
Okay, so where are we going first?
rabbit
Can you
here.
say what the purpose is? What about what they're about to see?
Um, the high level. Hold on.
I'm gonna go back here.
Uh, there we go.
Okay, so first we're going to share the high level overview or the big picture of what everything looks like right now. So,
All right, so I grabbed these numbers a couple days ago, and we put in into whole life the two policies we have, a little over 300,000. Um, we started in around May of 2022, and because both of us, our birthdays are in October and November of the year, we were able to backdate the policies. So in 2022, we actually paid two premiums, one at the beginning of the year and one on our birthdays. So we had two premiums in 22, one in 23, one in 24, and we just paid 25. So that's when I say we're in our fifth year, it's because the first year we were able to do something called backdating, which means we're able to push, uh, was it 6 months before your birthday, Bruce? Yeah.
Yes, yes.
Yeah.
And we can, and that can be something we can talk about individually. I don't think we want to get in that deep in right now, but there are different ways to get more premium in a short period of time in the first year.
Yeah, I just
Um,
wanted to explain because we're saying
yeah,
that I'm saying it's the fifth year, but we started in 22. So I was just trying to at least explain how
right.
we were able to do that. Yeah. Okay, so we have 282,000. Well, the green numbers, okay, in the way I broke this down, we have green numbers. This is assuming if we paid off the loan balance, because we now have a loan. If we paid that loan balance off today, or if it was, imagine we're in January 18th, um, the loan balance is for a little under 49,000. Um, if we paid that off, we would have 282,000 in cash value. The amount of that cash value that we could directly access is 260,000 or approximately, giving round numbers. Um,
Well, that Lucas, let's just that's the surrender value, but that would not necessarily be the loan value. So unless you already figured that part out.
yes, yeah, this is the amount that's just the cash value, and this is how much we could actually access.
Okay, so that is the loan value. Great.
Yeah, well, that
And
the loan is right here. We took a $48,000 loan. If we This is the max we could take in a loan, assuming we had no loans currently.
okay,
And then down
okay.
here in the yellow is with the loan included. Our cash value is 234, and we have available access to 211,000. So I just wanted to, because we were already tracking, this is the first loan we had taken, and I wanted to be able to still show what it would look like without loans. And then also for our purposes, we can see because there's a loan, how much can we actually borrow? But if we paid the loan off, I'm just showing in the green what it would look like.
so I want to explain something just for those of you that are not maybe as familiar. So basically what we're saying is we've paid in premium about 310,000. So let's just say that's this amount. I'm going to use like really, really round concepts here. This is this amount, 310,000. We have access to 282,000, so a little less than that in that that's our cash value is 282, which that amount, this is where I was saying we're getting closer to break even. That's 91% of the amount we've paid in. Pretty cool. Okay, so of 282, We have a loan right now that's basically 50,000. I'm rounding. It's less than that, but it's basically 50. What that means is this is our cash value here. We did not take out any money of our cash value. We have a life insurance loan where we're using the life insurance company's money and they have placed a lien against a portion of our cash value, against 50,000 of it, meaning that portion is no longer available for other loans at this time. But as we're repaying that loan, that amount is shrinking, returning the full cash value to its availability to be able to be used for new loans. Bruce, you look like you want to add to that.
Well, and just to remind people that any kind of return is based upon what you pay into the uh, contract, not what you have in cash value loan ability at any time.
Yes. Okay, so what you're saying is the growth is not based on the loan amount. The growth is based on dividends and interest. That's what you're
Yeah,
saying,
that was
correct?
The
another reason
loan's based
why.
on how much premium you paid in, not how much cash value you have to um, take a loan against.
Yes.
The full cash value. So that's
So what you're saying, Bruce, is you don't grow the policy more by taking a higher loan.
No, I'm just simply trying to tell people that, well, that doesn't make any sense because if I take the money out, which is what everybody thinks,
Right.
they're thinking, how can you get a return on that money? Well, that's why you can't get a return on that money because you're not taking your money out, you're taking out the the life insurance reserve money. So when you said you put 300,000 and they're paying you interest and dividends on 300,000, they're not paying you interest and dividends on the cash value of 282 or even lower after your loan. They're still
yeah.
paying on
Good.
300,000.
Yes. Okay. So good distinction. So there, the way the growth is happening at all inside of our policy, the way the cash value growth is happening is because of dividends and interest given, credited by the insurance company, and that full cash value is continuing to grow because they're paying dividends and interest on the premium, is what you're saying.
That's
Now,
exactly right. Because if people are comparing to a bank, they're going to say, well, if I put that same $300,000 in a bank and I go to the bank and take I take that money out of the bank, I stop making money on
yeah,
whatever I took out of the bank.
yes.
Okay. That's not the way it works on this. Now, some people then would say, yeah, but you have to pay loan interest that goes to the company, the insurance company, which is true. But you could do the same thing at a bank. You could do the same thing at a bank and say, I'm going to put my $300,000 up as collateral. Number one, they're not going to give you very much interest on 300,000 and it's going to be taxable. And they're still going to charge you an interest for a loan you take against your own money in that situation.
Mm-hmm.
Okay. And then the final thing is the person says, well, I won't take a loan. I'll just pay cash for everything. Well, then you're actually still losing out because you pay interest on anything. You're even giving up the interest you could make, or you're paying interest to some other entity. The big thing I wanted people to understand is that just because you only have a cash value of 282, or you've taken a loan and it's down here at I think it was 268, you're still getting paid at on $300,000 of premium.
Yes. Very, very good. And what I want everyone else to hear as well is we're not reducing the cash value, we're putting a lien against a portion of that cash value, meaning the whole cash value is still continuing to grow, which also gives us the ability to replenish, to repay the loan, free up all of that capital again, and be able to use the cash value as collateral for an additional loan as many times as we want to do that. Okay,
Go back.
to this.
hmm
Okay. All right. So where are we going next?
So effectively, the yellow numbers, right? We have cash value, and then cash value available was just meant, as I was saying before, that's how much the company says we can access of the cash value. So the difference being, if we take this is how much we can is available to us today. If we pay back this $48,000 loan, we would then have, instead of 211,000 and change, 260,000 and change. So that's just the difference. And then here in the green, you were saying we're at 91% of the premium we've paid is cash value. And then of that cash value of the premium, we can access just under 84% of the premium we've paid in the form of a loan. That's all these percentages are showing. So,
That just means you can't access all of your cash value in a loan.
correct. Yeah. Okay. So now if we look at this year by year, we did not capture the very first premium payment here when we did it. So I started it December of 2022, and I've been fortunately remembering every year on the 27th to capture the values there so you can kind of see from year to year. And what the first thing I think that is most important is that the cash value, the amount available, or cash value and the cash value available, the amount we can borrow. These numbers are, this cash value that you can borrow, that dollar amount's always going up every year. So the numbers just keep increasing. I will say this is when we took our first loan was March of last year. So you will see the cash value numbers, or at least the cash value um, does decrease a little bit here. There's a loan, and then Bruce, I was going to have you explain
Yeah, so
premium
there's
refund.
something. Yeah, it's the premium refund, and we don't have to get in a big you know depth of this, but one of the reasons it goes down is because they pay annually, and we always encourage everybody to pay annually because when you pay annually, you get to two things get to happen. One, you get less expenses from the insurance company because they only have to deal with one premium. One, so the costs are down. They don't have to send out notices every month or every quarter or semi-annually. And you're also prepaying for the entire year. So if you, let's just say you're paying on January 1st and you die on January 2nd, well, that premium was covering you for the entire year. So you actually died before you actually needed to use all your premium. So the insurance company actually gives you credit for that. They give you credit back, what they call premium refund. So every day the premium refund, though, if you don't die till January 8th or February 1st, then obviously you're using some of that premium that you paid all at one time. And so the premium refund every day gets less and less and less because you're using it every day.
So,
So that
Bruce, if
is
you've paid
the
annual
best.
premium and you didn't die at the end of that year, then you actually would get back the death benefit check would be death benefit plus premium refund, is what you're saying.
Correct. Correct.
Wow. I did not know that.
Yeah.
Yeah.
So that's why if you go back to the spreadsheet, you'll see from this again, this is assuming no loan was taken on the green. So and we were recording these numbers in December. We took the loan in March, so the cash value went down a little bit. But what you notice is the amount we could borrow against the policy just kept going up, and so that's that premium refund. He's saying some of that cash value component is comprised of the premium refund value, and so we don't need to go deeper in that. But that's why for those people who might look at all the numbers and go, but wait, why did this go down between here and here? But
Yeah.
you'll notice if you look at it annually, the cash value though is always going up. And even from there to the 2025, you see an increase. In fact, between our two policies, we put in 50,000 a year in premium, and you'll see that the cash value went from 231 or almost 232 to 280 471. So it's a little bit more than we actually paid in total between the two policies. In mine, I think we'll look at it. I think in mine it goes up more than I paid, and yours it's like slightly less, but total combined it's still more.
Which that's really exciting too. So maybe even more valuable than,
Sorry.
you know, talking about other numbers. It could be that one of the most important or interesting years are what at the year that your cash value grows by more than the dollar amount that you put in. And so overall, our entire family banking system, that's happening now.
Yeah. Okay. So I think we got through that. Okay, we're going to look at, so if we go to just my policy, um, you can see between, yeah, so between December of 24 and December of 25, 29, 30, so it's more than 20,000 premium paid on this policy. So the cash value went up by more, and the amount available, same thing. You see it went up by more than was paid in. And then it was my policy we took the loan against. So you can see over here, you know, we took the loan, so the cash value went down, but then we paid premium and we paid a little bit of the loan down. Um, Not much, but a little bit. And so we're just monitoring this. And I think the plan basically would be, well, we're just going to update it. I'll try and stay on track with December 27th if I can, or close to it. And then anytime we take a loan, just kind of the major milestones. Now, December 27th is a little bit after we pay our premium. So our anniversary dates, mine's October 28th, yours is November
November 22nd.
22nd. So there has been some cash value, the cash value available has increased a little bit from when we paid our premiums between those dates. So this is just the date that we decided. It's after both of our premiums are paid and everything's kind of settled with the company, and we're able to go into the portal and see the exact numbers. So that's just kind of why we do it that way. And then,
Yeah, Lucas, this is a good time to tell everybody that the reporting at the life insurance company is not as detailed or instantaneous as it is at a bank. They were never intended to actually have reporting that is similar to a bank because it's not a bank. It's a financial institution, but it's not a bank. So a lot of people get hung up a lot of times with, well, I want to know the amortization. I want to know how much my interest was just for this loan that I took out, even though I have multiple loans, so on and so forth. I want to know why you can't show me and on an illustration, my payback in the first year and so on and so forth. These are things that a lot of our clients, I shouldn't say a lot, some of our clients get hung up on. And we say, hey, listen, the insurance company is not a bank. So they don't have these processes in place, but we're doing this to mimic the bank. And so you have to understand this conceptually, and we have to extrapolate some of the information from the reports that they will provide you, like Lucas is showing you. You extrapolate some of that from that. Um, the main thing is that you just have to understand is you're part owner of this insurance company because it's a mutual company. So you benefit from everything that's going on, even paying interest to the insurance company itself, because that's one of the ways the insurance companies make money, and thus they can pay you then a higher dividend. So I just wanted to bring that up because some people, um, when Lucas says this is the time when all the things that happen, when you make a premium payment, it comes from a traditional bank. Traditional banks then have some time period where they will not even allow that money to be cleared. In other words, they have to make sure wherever it's coming from, it actually had the amount in that bank, which I'm still like mortified that we even have this system because in electronics now you would think that they would be able to communicate a lot faster, but they don't. And the same thing happens with some other payments to an institution. If you look in your bank account right now, I have pending things.
So do
It'll
we.
say
Yep.
in my bank, it'll say, here's your balance, here's your pending balance. So even on every day, banks don't work like this. But people somehow forget that. They just think everything's instantaneous. So
yeah.
if you're wondering why Lucas is saying our anniversary date's this, but then we look at it on this date, it's because one's pending, and then one's when it's actually everything's cleared. And so that's why
Yeah.
I just thought I'd bring that point up.
Yeah. Yeah. I think December 27th for us is a bit past because no, Rachel's premiums due November 22nd, but it still takes, I don't know, depends on the
It
company.
usually takes, I tell people it takes between 12 and 20 days
Yeah. But
for
part of that
everything to
too
get
is,
reconciled.
and part of that is the insurance company. I mean, you can call them and they'll tell you, here's
Yes.
what it is, but they're trying to protect themselves from, that money actually not the other bank coming back.
Yeah.
And
And banks do the same thing. I
yeah.
just deposited some big checks today in my bank, and they said, I'm sorry, but we have to put a 7-day hold on this, which does not include the weekend, which is basically 10 days.
Yeah.
So banks did the same thing to me.
Yeah. I've seen that before. Okay. So
Let me go back to yours.
yeah. So all this is showing really is that between this, 20 December of 24 and December of 25, you can see with that 1 year's premium payment, we're at the point where we're getting or the policy is increasing, the cash value is increasing more than paid in that year. So I guess that's a form of a break even. It's not break even
Hmm.
in the sense that the total cash value equals all premiums paid. That will come in a few more years. But if we let's go ahead and look at yours. So if we look at yours, yep, and you'll see it's not quite. It's
Well, what are you looking at? So,
well, if you look at the cash value available from, oh, is it not showing the year to the left? There you go. So if you look at the December of 24 to December of 25, the cash value went from 90, little under 91,000 to 119 and 500. So it's not quite. It's really close, but it's not
because
quite.
we're paying $30,000 a year into this,
Yes, correct. It didn't go up by 30,000, but it went up
right?
close. But
In
what?
these two numbers.
Right. Yep. So yours is a little bit under, mine's over. Total combined between the two policies. That's why we saw for both of them that it was going up by double. Okay, so we covered that. Let's look at let's go to the PDF illustrations. I wanted to show Rachel's policy's original illustration, which would be go over one. Okay,
Do you
this
have
is
exactly
when
where you want them?
it's right.
Is it
It's fine.
here?
It's fine.
Okay.
So this is showing. Oh, it's not up yet, is it?
Nope.
Okay.
No.
So here we're looking at before we even paid the premium. This was the illustration that was created at the time of purchase.
Can you make
You can
that?
see,
Could you make that a little bigger for um, the
I
audience?
think I can. Tell me this. Is that getting bigger? No.
scroll.
Hold on.
No.
Is that getting
There you
bigger?
go. Right there. That's fine. Yes, that's fine. Right there.
Okay. So you'll see, um, let's go ahead and just look at, if you look at, okay, so the in-force illustration won't show years one, two, three, and four because those premiums have already been paid. So what we want to look at is age 41, which is year five. And you just go look at yeah, that year.
So here,
Uh,
which I can't really highlight.
no, but you can go over
Oh, hold
to,
on. I can annotate this. Okay.
yeah,
So right here.
yeah. So if you just underline the dividend and I can take over if you want, but that and the net cash value and the death benefit.
Oh, okay. Not this one.
Yeah. So, okay, so you notice that the dividend is a little over 8,000. The death benefit's 795, net cash value 134. So if you go the spreadsheet over, which is your in-force illustration,
Over here.
yep. So if you look at
So this is now an in-force illustration, which means the illustration that we get that shows where we are right now, where it shows
correct,
starting
age
today.
41. Yep. So if you look at that and you see the dividend is a little over 9,000, whereas in the other one it was 8,000 something.
8,087.
Yeah, so
8,100. 8,187. Because I'm doing the math right now.
right. And then you look at the cash values a little bit higher, probably because of because
It
of
was
increased dividends.
134. It was 134, 353.
And then the death
So it's
benefit.
about $1,450 higher, $51 higher. or
And then the
$41 higher.
death benefit 797.
Yeah, I didn't write down the death benefit.
It's okay. The other
Um,
one was 795 something.
yeah,
The only so it this doesn't look like a huge difference, right, between these 2 years. But if you look at it going out, it will be. We will compare that. I think, but the main reason we want to show this though is just to show that well, illustrations are just projections into the future. So what's happened since 2022 to 2025 is the company that these policies are with has increased their dividend, I think three or four, I don't know, at least three times. I don't know exact. I don't remember now, but I know
yeah, I don't. You're right. It's at least three times.
maybe four in the time period since we've purchased the policies. So that means if the dividend rate is increasing, then future numbers are going to get bigger and bigger. The dividends are going to be bigger and bigger
Bigger than they showed on the initial
than the initial
illustration.
illustration.
Yeah, let's talk about what they do on the illustration. When they do the initial illustration, they take whatever the dividend rate, crediting rate is for that year, and they project that dividend crediting rate for the entire contract for up to year 121. So they don't make any predictions. They just say you're taking it out in 2021. Here's what the dividend rate, crediting rate is this year. We're just going to assume that that's going to what's going to be until your age 121. When you get an in-force illustration, which you just did, then they're going to say, well, here's what the dividend crediting rate is now, and we are going to change now, whatever it is now, or it could be the same from 4 years ago. But if it changes, we're going to take that dividend crediting rate and we're going to project it all the way out to age 121. And so it could be higher, it could be lower. I mean, we saw that. We saw dividend crediting rates go down after the 2008 financial crisis. What was interesting is, though, then we saw something that hadn't happened in the 125 plus years of looking back at these interest rates. The interest rates then were held at near zero for almost 12 years. And the insurance companies had never dealt with this before. And so they just held their dividend crediting rate. Many of these companies did not change them for 5, 6, 7, 8 years. They just held them steady. So then if you would have done an in-force illustration, it would have looked just like the original illustration. But now, because we have interest rates that had gone up, now the companies are now increasing their dividend crediting rate. Why? Because they are now buying bonds, both corporate and federal treasury bonds, at a greater rate, at a much greater rate. And we expect that, and they expect it to actually be more normalized going into the future. So what happens with these insurance companies, they say, when they were being held for such a long time, the good insurance companies say, we don't know when this is going to stop. So we're going for our policyholders to protect our policyholders. We're going to pull down the dividend crediting rating to not overextend ourselves so that we can make the promises we're going to make. And so they held them low. Even when they went up, they still didn't tick up their dividend crediting rating that much because they were like, how long are they going to stay up? But then as they stayed up for several quarters, they increased their dividend crediting rate. Now, some of the people might be saying, because we're here January 2026, they might say, but the Federal Reserve actually took them down three times this past year. Does that mean our dividends are going to go down next year? My prediction of doing this for 40 plus years is no, they're not going to, because they're still 4 to 5 times higher than what the ones that were close to zero were. So they're normalized. And so going forward, I still believe we're going to see increases in dividend crediting rates, even though the interest rates have come down a little bit. So I just wanted to give that quick synopsis of why the in-force illustrations. And now, Lucas, I think you wanted to show a couple of numbers of the compounding effect of this, or the potential
Yeah.
compounding effect of this.
Yeah, that'd be good to do. So if we just go to age, if you share the PDFs
Which one do you
again,
want me to share? This one
let's
is
go
the
to the original.
in-force. So
Yeah,
this
go to
one?
the original and go out to age 75. That's yeah, a rate highly likely that quite a few people live to age 75, so we're not going too far out. Plus that's also as far out as you can pay the premium. So if you go to that year and look at the dividend, 75, yep.
Okay, so let me.
70,000. No, I'm sorry. It's yeah, 70,683.
What are you looking at, Bruce?
Age 75.
The
Oh,
annual
yep.
dividend at
Okay.
age 75.
I was looking
Okay.
at the wrong line. Okay, here.
And this was
Cash value
the
indefinite.
original where they took the dividend crediting for that year in 2021, I believe you said was when you took this out. So interest rates were
22.
still relatively low, and they just took that dividend crediting rate and put it out to age 121. Okay,
Yes.
now we're going to go to the in-force illustration that Lucas just did.
Okay, so hold on. I want to write these down. So 70,000, we've got 2.484 million and 3.227 million. Okay,
Okay, then go over to the other.
I'm gonna clear this first. Okay. Okay, now age 75.
Now, these are
Yep.
still projections, but they're projections using numbers, real numbers for the last 5 years. So
Yeah.
now we go out to age 75, and the annual dividend went from 70,683 to 102,036. If that doesn't show the power of compounding, even if this doesn't happen, because these are only projections, what Lucas and I did on our prep was we said, let's show the power of compounding.
Mm-hmm.
So you got a little change, an $860 change this past year from what was projected and what actually happened. And that $860 just in this 1 year of dividends changed to from 70,683 to 102,036. Now let's flip this. Let's not even talk about how much money you make. Let's talk about the compounding of paying debt interest. The same thing works. So if you were paying credit cards and you weren't paying the credit cards every month off, they would compound the same way. It would be astronomical. So now, Rachel, it's kind of fun. You go over to the cash value, and instead of
Yeah,
having
it was 2.484.
2.4,
So
you
it
almost
was,
have a half a million more dollars,
yeah,
And the
and
death
you have
benefit's
six
even
hundred
higher.
thousand dollars in death benefit.
because
Yeah.
it was 3.227 million.
Yeah,
Yeah.
so you
So
have
it's
about six hundred thousand
600,000.
dollars more in death benefit.
Yeah. I mean, that's a significant difference in the death benefit. So
And yes, and so I think it really shows compounding and why it's important not only to start early, but it also talks about the importance of paying your premium every year, the max premium that you can pay.
yes.
100%.
Well,
And all of these illustrations do show paying as much premium as possible.
well, and also I think it should help people realize like if you're making a decision based off if you're looking at two policies and all you're looking at is going out into the future and comparing the cash value between two illustrations, like um that's not a good methodology to decide which one's better because there's these illustrations are snapshots in time. Dividends can go up, can go down. So what we do know is whatever's on that original illustration when someone's buying a life insurance policy, that the dividend there's you look at any history of any of the companies, they're never static. They're not static
No,
for more than maybe 3, 4, 5 years. They're going to change, and so you don't know what that far out number is going to be. And so sometimes, though, I think it's very easy because we're trained to think in terms of rate of return and numbers and whatever's the largest number that we somehow, because it's a number in front of us, we treat it like it's truth, like it's true.
right.
And
Very good.
we don't know what that future number is going to be. We just know that it's always going to be higher. As long as you're paying your premium, those values are going to continue to go up. That's what we know. By how
Very good.
much, we don't know. And I think people sometimes will try to make a buying decision with life insurance just based on comparing numbers and illustrations, but there's a lot of other factors to consider. So,
Yeah.
um,
Lucas, let me just make another point. Lafayette Life, and this is who you have your contracts through. They are what's considered a non-direct recognition company, and what that simply means is they don't recognize when you have a loan. They keep the dividend crediting the same whether you have a loan or not. There are some companies out there that are non-direct, and the infinite banking concept can still work with those companies. We're not disparaging those companies, but what we want you to know is if you take a loan with those companies, they still give you a dividend crediting, but they lower the dividend amount that they're going to credit you for how much you have loaned against the policy.
And just
Now,
for clarity, those are direct recognition, the companies that do that.
yes, they
Okay.
directly recognize the loan.
Yes.
Now, just like Thomas Sowell said, there's no solutions, there's only compromises. So, what's the solution there? Well, there is no solution, there's a compromise. So, then what happens is the direct recognition companies tend to give you a little more dividend crediting, just a little more dividend crediting on your normal one
Okay.
because they know
On
they're
your
going to
regular
give you
dividend.
on your regular dividend. So, but then if you take a loan against it, they're going to lower whatever you have, but then they might average out to the non-direct recognition. However, if you don't pay your loan back, this is where Lucas was talking about, is then you do an in-force illustration. It's not even going to be anywhere close to the original illustration because now the dividend crediting was considerably less than what was projected on the illustration to begin with. So, Lucas, you're very wise. We should not be making buying decisions based upon that number. You know, you're right, Lucas. We have clients all the time that go out to year 75 and they'll say, we actually have one client, not I won't name his name, but he actually said to this, Bruce, I understand what you're saying, but I go out 30 years and I see this company has 20,000 more cash value than this company. I can't sleep at night unless I pick that company. And I said, okay, well, we'll pick that company then. Even though it was a direct recognition and I knew he was going to use this, and it probably wasn't going to be anywhere near. I was just thankful that he was taking the banking function into his life and utilizing the policy. We weren't going to worry about what the rate of return is just because, just like Lucas says, it doesn't make any difference. We know we're going to get something. We just don't know what the snapshot in time is going to, actually be the same as the future snapshot in time because they're all snapshots. That's why they call them snapshots.
I do want to clarify one other thing as well, and we don't have to go into this on the illustration, but when we look at the growth of the cash value based on dividends and interest, the dividend is not guaranteed. That's what we're talking about, that it's a projection. It's based on today's dividend rate. However, the interest is growth that is guaranteed in a policy. And so you have a guaranteed and a non-guaranteed side of the illustration. And all that means is that I'd mentioned earlier that one of the reasons that we really like whole life insurance is that there's a lot of predictability and guarantees. And so I just wanted to reconcile this idea of we've got predictability and guarantees and control over here with this idea now that we're saying you can't, count on the numbers that you see in advance because they're just a snapshot in time. You do have a guaranteed premium, meaning when you pay the premium that is illustrated, it's not going to go up on you. They're not going to say, oh, you set up this contract for $30,000 per year. Now, in order to fulfill the life insurance company's side of the contract, we need you to increase your premium to 60,000. That's what I mean by being guaranteed. It's not going to go up in order to fulfill the requirements. The death benefit is guaranteed, meaning there is a minimum guarantee that's going to be listed on the guaranteed side of the illustration. Also, there's a guaranteed cash value dollar amount, not a guaranteed growth rate or guaranteed rate of return, but a guaranteed cash value dollar amount on the guaranteed side of the illustration that really shows you if no dividends were ever added to the policy. So I just wanted to clarify there are guarantees. The dividend is not guaranteed. However, it's highly anticipated because these companies, especially the ones that we're looking at and the ones that we use, have been paying dividends every year for what, Bruce, 170 years or something like that through upheavals and economic uncertainty. I'm not sure exactly the number of
Each
years,
company
but
is different because some companies
Each,
started
each company's different. Lafayette Life is since 1905,
okay.
so it's 121 years.
Okay.
There's some of them are 130, some of them are 140, and you're right, some of them get to 170 years.
Well, that's just
Um,
because they existed
they
longer.
existed at that
Yeah.
time, yeah. There's only one, and I won't mention the name, but there's only one mutual company that I know of that's in existence today that 1 year in 1887 missed a dividend payment for 1 year, and it was, 1887. So it's been a long time since they missed a dividend payment.
So even though they missed that one, they still paid all through the Great Recession and all through the dot-com burst. Yeah, they've paid a lot. Okay.
If we have time, the only other thing I was thinking we could do is go over one of the annual statements. Do we have time for that?
I think so. We started a little bit late, so we're 53 minutes in.
Okay.
54 minutes.
So if we can pull
Okay.
that up, I
Which
got
one
it
do you want?
right there. Yep. This
Is
is
that where
my
you want it?
annual statement. Yeah. And one thing before Bruce, you cover it. If you look, it says the policy date says 10/27/2021. That was what I was trying to say earlier was well, we started in May of 2022 because we were within the window to be able to do what they call backdating. They still keep it to your birthday or the day before your birthday. So the anniversary or 10/27 is the day before. So they start the policy um, as if we paid the premium starting back then. So um, that is why it says 2021.
Very good. Yeah, so just a couple of things I think are interesting on these is Rachel, if you can make it just a little
Oh,
bigger.
yep.
If you go down to the total dividend, which is where your hand is just about there, which was that year was 63.41. No, the lower right. How your
Okay.
dividends, your total dividends paid this year was 63.41.26. So that's the total dividend that was paid. And obviously that was from last year. But then it breaks it up and it tells you how what parts of the policy were actually contributing to this dividend. And the first thing is the base dividend. And the base dividend actually shows that of the 63.41, that 26.76 was actually the base dividend. Now, you guys have a unique thing because this is a 1035 exchange. So the paid up additions dividend is only $222. Now, the paid up additions dividend of $222 is simply the dividends that you are earning from the dividends that you earned the year before. So those dividends were added to your policy in the form of additional cash value. This is a good time to talk about this. Once a dividend is declared, it's guaranteed. It can never go down. So then you're going to get dividends from the cash value increase of your dividends. So it's compounding. Then you have the level paid up additions, PUA rider dividends. That's the next one, 1391.23.
Bruce,
And
let's just point out that that's also because we've chosen to use the dividend option to have the dividends added back into the policy. If for any reason we were pulling those dividends out of the policy as income or something like that, it would not continue to grow dividends on top of the dividends. But is that correct?
that is correct. That is contractually an option you could take. We very rarely would ever do that, but that is contractually you could do that.
So you
Um,
want the compounding on your compounding. You want to add your dividends back into the policy to improve the growth.
correct. So then the next part, the level pay PUA's dividend is 1391.23, and then finally, because you guys decided to do a 1035 of cash value from one policy into another policy, you did a single premium PUA, which is why you got 2051.47. So this is a little bit of a unique policy. Most people's policies will not be like this, um, because 1035s are pretty rare where they make sense to do. Yours makes sense because of the particular company that you had originally, but it doesn't normally make sense. But the last thing I wanted to show on this, Rachel, down here anyway, I have a couple other things I want to show is every time that dividend, no matter where it comes from, underneath that dividend, it shows how much additional death benefit it has purchased.
Okay. Yes. Okay. I wasn't catching that on I was going to ask what those were. Okay. Awesome. So that dividend has purchased additional death benefit, which is these amounts.
Correct. And that is really important because these policies are going to endow, which means the cash value and the death benefit is going to equal each other at age 121, then every time that you can increase the death benefits, the cash value has to chase it and get greater every year in order to do that. So increasing the death benefit automatically causes the cash value to go up.
Got it. Okay, that's really helpful. I'm going to ask you another question here. Bruce, total dividends this year, 6,341, which I'm assuming is the addition of all these underlying numbers.
Correct.
What is this
Yep.
dividends grand total? Is that through the whole life of the policy?
Correct.
Okay.
Correct. Correct.
So that's the difference between the 6,000 and the 19,000.
Yes. And then
Okay.
another thing we should probably point out is the base premium up at the top, Rachel, is your 74.71.44. That's the premium. And that is giving you that base debt dividend of 26.76. So if you want to go down and point to that again, or put a little dot at 26.76, the first dividend. So that's what actually
Correct?
contributed to that. Okay, along with all the other premiums. But then if you go to the level premium paid up additions rider, which is 10,855, it contributed
You mean the
28,826.
Yeah.
you mean the
The level
13?
premium, I'm sorry, the 13. Yes, thank you. So as you can see, even though the single premium was greater, you got less of a dividend. Now, a lot of people say, no, that doesn't make any sense. Well, here's the reason why. The single premium, level premium paid up additions rider, any of those PUA riders, they're not figured actuarially to get paid every year. You want to pay them every year, but they're not figured to get paid every year. So don't make it more complicated than it is. The level premium paid up additions rider, $10,855.50. When you pay that to the insurance company, it's going to increase the amount of insurance, and that amount of insurance is paid up. You never have to make another premium payment. Never. For that year. You can next year if you want, but you don't have to. However, the base policy of 74.71.44, you have to pay that every year. So they know they're going to get more cash in the form of premium every year to pay. So because of that, they can then do more long-term planning. Thus, they can make more money on those long-term premiums because they know next year they're going to get it. They're going to get it. They're going to get it. So that's why they can give you a bigger dividend on the base, even though it's a lower premium. And then
Which is why, and I'm having to remind myself of this because we've had this conversation before, but that's why you do want base premium in your policy. I mean, not the only reason, but it's a reason that when dividends are going well, and especially when they're increasing, you certainly don't want to have had a 10% base policy and all of this PUA that's great for your cash value up front, but if you're in a position then where you're not earning as many dividends, you might not
There
have
are
as
no
good of
there
long-term
are no
growth.
solutions, only compromises.
Well, the other risk, which is a lot of people are doing this because they want to borrow against their policies, but then they want to lower that base really low. But then that means it's going to take a lot more time for the policy to be in a situation where you don't run into risks of like tax issues where you could there is the potential. We don't have to go into
You can make
details
the
on it.
policy. Yeah.
Yeah, meching or there's I think we've talked about it in other episodes, but yes, having a higher base means you're more quickly going to get to a point where the policy you can borrow heavily against your policy and not be as concerned, have to really worry about that issue.
Yeah, and like you said, Lucas, we've gone over that in other. We probably don't want to get too deep in it, but that's the reason why you have that 30-year term rider. If you would have had less of a base premium, then you would have had to increase the term rider. And if you increase the term rider, then you increase the cost, and it also uses up more of your insurability. So all those things are a factor in policy design. The final thing it, I want to point out, because a lot of clients get confused about this, is look at right in the middle of the page on the right hand side, premium deposit fund current balance. You see where it says $30.80? That's because Lucas is so good at paying his premium, he pays it early. So if he pays it too early, the companies will not apply it to the policy yet, because if they did, they would mech the policy. So it stays into the account earning interest, which is taxable just like if it was at a bank. And so you guys earn $30.80 of interest that you can continue to earn interest on if you want. You could
Yeah.
use it. You could use it next year to offset some of your premium. Or what I would suggest is you call the company and tell them to apply it to your loan.
Yeah.
Awesome.
It won't make a huge difference, but you may as well pay down your loan with that $30.80.
With other people's money instead of our own. I
No.
like it.
Well, it's a
Yeah,
little bit
The
of
interest growth of someone else's money.
yeah, and
um
then look at the interest rate on the left hand side. You guys were paying 7%, but now because interest rates have come down, you notice at the very last sentence, the loan interest rate for the upcoming policy year has gone down to 6.75.
yeah.
And what
Oh,
I like
wow.
to
Okay. And is
Yeah, and
that that's
what I also like to point out is if you look at the $50,000 of loan taken and it had 7% interest for a full year, what should the interest on that loan be? $3,500. And yet the interest amount owed was 2132.42. And there's a variety of reasons for that. You probably didn't have a full year on the loan. You could have made some payments back, because it says, say right there, loans repaid including interest of 2980 right above there. So I'd like to point out to clients that just because it says you're paying 7%, the way they do their loans in a simple interest way is the likelihood you're going to pay that full $3,500 throughout the year. If you're paying your loan back, you're not going to pay $3,500. So are you really paying 7%? No, you're actually paying less than that. And
that's fascinating.
yeah, you can see that right in your loan right there, because you only paid 2132.42 for that loan that year.
Yeah. One other thing was more of a choice that we made. I don't know. It's probably not as common for people to use the waiver of premium benefit rider, which you see there. We did it well, that's on the term rider. So they have waiver premium on the term premium
Okay.
and on the base policy. So that just means that in the event that I become disabled, the premium will then be paid by the life insurance company. So it's just it does reduce it is a little bit of a reduction, or you could say a drag. So if you want to say it that way, on the growth of the cash value a little bit. If we didn't have that there, the cash value would be growing faster. There'd be a little bit more death benefit because those premium dollars would then be allocated to just death benefit and cash value growth. But again, this being a savings mechanism, a place to store cash and not wanting, not the growth isn't the main point of using it. It's for access to capital and for future generations, having that extra protection there to ensure that this is self-completing. So if I become disabled, this thing's going to complete. If I die, it's going to pay the death benefit out, which is self-completing. So I just have re mitigated as much risk as possible when we put these waiver premium riders on our whole life policies to
Yeah.
ensure that if something happens, the premium's still going to get paid.
Yeah. And just to clarify that, Lucas, the every life insurance company that I know of, the only premium that gets paid is the base and the term. The PUAs, because they're not required, do not get paid.
Correct.
So just for I'm sure our insurance companies are grateful that we clarify that.
Oh, yes. Um, yes, but so yeah, the PUAs wouldn't get paid. So there, it would be just a reduction in the amount of premium, but it still is way better than if I became disabled and couldn't pay the premium and then all of a sudden,
Oh yeah.
yeah,
Well, yes. And we
So
all know Rachel had her little health issue, and so it could have been that she wouldn't have been able to continue to be a productive person in society and actually make money and became disabled, and her contract would have been paid for.
yeah,
which is
So
a lot of peace of mind. And I think sometimes you could think, well, if I'm just looking at all the worst case scenarios, is that really peace of mind? I want to share something. Um, it really helps to know that even if these negative things happen, there is a solution for that. And I guess the solution to those questions is pay more premium. I did want to point out something here on um, I guess the in-force illustration. We talk about a leveraged up death benefit, and I just want to point out something really cool. So let's just go like anywhere in the policy. If you look at the Bruce, is there a line that says the cumulative premium? Maybe there's not.
not in the enforce.
you
So
have to go to the original.
it probably, if you go to the original one, you can see the cumulative. It's in the middle of there.
Okay, so cumulative premium. So if you look here, um, let's just look at, I guess this would be
Look at
age,
year 75.
yeah,
Yeah.
age 75.
Yep. Because that's when you stop paying premiums.
Okay, so at that point, premiums paid in would have been a little over 1 million. The death benefit is over 3 million,
So it's over three times as much.
which is really powerful. And if you look, then this death benefit continues to rise throughout the time after that as well. And so that just the number just continues to go up because you don't
Yeah.
put any more premium in, and that's
So if you
continuing
live
to
to
increase.
85, 90,
I'm planning to live to 120. Don't
I know,
forget this here.
even at 90, you're just under 5 million. So, I mean, it's a five times multiplier. So, depending on how long you live, of course, will determine that multiplier. But
But if we go out to age 120, which is what
right.
I'm banking on, it's 11 million, which is pretty awesome. So when we talk about that, this is a key way then to be able to have a tool that you're putting dollars into now that in generation two, they will have more dollars because of this particular tool. And if you have proper guidance, proper training, stewardship, and that generation two catches the vision for what is possible, and they use that death benefit to put additional premium dollars into policies in their generation, they can amplify or accelerate in the same way in the coming generations. And so you literally have this leaping effect from here's premium in year one to premium in year two to premium, not year, generation one to premium in generation two, premium generation three, premium in generation four. And this is without any new dollars. If you just, as generation one, initiating this process, pay premiums into a policy, and that gets used generationally in the way that continues to use death benefit to pay new premiums, you have a self-funding perpetual wealth creation tool that can really just benefit and bless not only your family but charities, anything that you want to give, anything that you want to use capital for in coming generations, which is just so powerful if you're able to have a family wrap around that vision. So that's a lot of the work that we're doing with Seven Generations Legacy and the planning and consulting and the work that we're personally doing and the vision that we have for this banking system. That's, I mean, I like to say the person with the longest range vision wins. It really is true. I think the reason people don't put life insurance policies in place is because they're thinking, what can I do to get the highest rate of return tomorrow or next year or, in 5 years or for my retirement. But if you start thinking to the end of your life or generationally, this is a tool that really makes sense to put you in control, have certainty, have guarantees, and to just be able to create tremendous leverage in the coming generations. So anything else that you want to add or share before
I think that's a
we wrap
wrap.
here? All right. So if you want help implementing any of these principles, any of this strategic cash flow management system in your life, if you want to ask questions about family banking, if you are ready to take action and be able to begin implementing in your own personal life, we would love to talk to you. And you can go over and go to themoneyadvantage.com. On that main website, there is a link to be able to book a call on our advisor's calendar and be able to start the process of talking about how to implement family banking, infinite banking with whole life insurance the way that we have discussed today. And also, if you're interested in more information about Seven Generations Legacy and the planning there, we have the Seven Generations Legacy book. We have several of them on the shelf behind me, I guess right there. You can go to sevengenerationslegacy.com to get the book and get started with that process and that thinking about generational wealth creation. So, in closing, please remember success leaves clues. So, model the successful few, not the crowd, and build a life and business you love. We'll see you next time. All right.